Welcome to the Deep Dive, where we cut right through the noise and get to what really matters. Today, we are digging into EVgo Inc., that's ticker EVGO, and their Q3 2025 earnings call.
And this was a really important one.
It felt critical, yeah. The market clearly reacted well. I mean, we saw the stock jump pretty aggressively pre-market as soon as these results landed.
It did, and that reaction was, I think, entirely justified. This call really reinforced the core thesis the market needed to see.
Which is?
That the company's whole long-term focus on network scale and high utilization is finally translating into financial performance. And they didn't just give vague improvements, they gave a concrete timeline for a huge financial milestone.
Okay, so let's unpack the results that drove all that initial enthusiasm. We're talking about some pretty substantial improvements, right? Starting with the top line.
Yep.
Revenue came in at $92.3 million. That was a slight beat. And a healthy 37% jump compared to last year.
But for a growth company like this, the real story is always a little deeper on the operational side. The path to profitability.
Right.
And we saw a significant improvement there. GAAP EPS came in at -9 cents. Analysts were expecting -16 cents, so that's a really substantial beat. It shows they're getting a handle on the cost structure.
And what about adjusted EBITDA? That's the one everyone watches.
That metric swung from -8.9 million a year ago to -5 million this quarter.
So the trend is right. That's exactly what the whole utilization argument promised.
It is. They're clearly finding efficiencies, and you can see it plain as day in their gross margin.
That was a big highlight, wasn't it?
A major highlight. It improved to 13.6%. And to put that into perspective for you, that's an increase of 420 basis points year over year.
4.2 percentage points.
Exactly. A 4.2 percentage point gain in efficiency on every dollar of revenue.
Yeah.
This isn't just about, cutting a few costs here and there. It's about making every single charging session more profitable.
That feels like a huge structural shift. So what's actually driving it? Is it just more stations, or are the stations they already have getting used more?
It's the latter. It's absolutely the latter. This isn't some kind of financial engineering. It's raw usage driving the numbers. Charging network revenue had a record 55.8 million, up 33%.
Okay.
And the key metric supporting that is energy throughput. It hit 95 gigawatt hours, a 25% year-over-year increase. That utilization, that's the engine. It's the whole reason the shares popped 6.7% right after the announcement.
Let's focus on that then. The operating metrics that are underpinning all this, they're still building like crazy, right?
Oh yeah, aggressively. They added 280 new stalls in Q3, which brings their total network to about 4,600 stalls. That's a 25% increase in a year.
But just building is the expensive part. The question for investors has always been, are those new stalls actually profitable?
That's the tension the market has been watching. And the answer is right there in their main utilization KPI. The average daily throughput per stall is now 295 kilowatt hours.
Wow.
And management really hammered this point home. That volume represents a six-fold increase in usage since just the first quarter of 2022.
A six-fold increase in a little over 2 years is remarkable.
It's far outpacing the overall EV market expansion.
So why is the stock still down 37% over the past year? Is the market worried that these tailwinds, the rideshare electrification or government incentives could just suddenly dry up?
I think they are worried about duration, but management was very clear on what's fueling this. They pointed to three things. First, the demand from rideshare and fleets. Second, more affordable EV models are finally hitting the market. And third, the vehicles themselves can just charge faster now, which lets their 350 kilowatt infrastructure cycle cars through more quickly.
It all comes back to throughput.
It all comes back to throughput.
So if that's the story, then that highly anticipated Q4 2025 adjusted EBITDA break-even target suddenly feels, credible.
It becomes very credible. And the reason the Q4 inflection point matters so much is because the company's cost structure is so heavily fixed.
Right.
Think of it this way. They've already paid for the big fixed costs. The site lease, property taxes, a huge chunk of the G&A staff, you need to just run the whole corporate machine.
This is the moment of truth.
Exactly. Management clarified that about 28% of the charging network cost of sales are fixed. And importantly, roughly 2/3 of their entire G&A expense is fixed.
So once they get past that hump,
once the gross profit from the charging network itself exceeds that fixed corporate cost base, profits should accelerate really, really quickly. I mean, every kilowatt hour sold after that point Basically drops straight to the bottom line.
That fixed cost story is the key. That unlocks the whole investment thesis. It means they're not just improving margins incrementally, they're setting up for, potentially exponential profit growth once they cross that line.
And they weren't shy about the long term either. They guided toward $500 million in adjusted EBITDA by 2029, with margins in the mid-30s.
And they made a point of saying they have the financing to get there.
A huge point. They emphasize they have the financing secured through 2029 to deploy all those stalls without needing to tap the equity markets again. Taking dilution risk off the table like that gives them a really long runway.
Okay, but this kind of aggressive expansion needs really tight capital discipline. Let's look at their financing. They ended Q3 with a healthy $201 million in cash.
Yep.
And then they drew another $41 million from that Department of Energy loan in October. And they also have that big commercial bank facility.
Right, the $225 million facility that can go up to $300 million. They're managing that capital really efficiently. And this is where the operational expertise it really shines.
How so?
They noted that the net CapEx per stall for the 2025 build is expected to be $75,000. Now, that sounds like a lot.
It does.
But it's actually achieved through a 40% reduction in costs compared to their initial projections.
40% is a massive reduction. Where's that coming from?
It's mostly from what they call capital offsets.
Yeah.
So you're talking incentives, state grants, utility programs, and these crucial infrastructure payments from the OEMs themselves.
So the car companies are helping to pay for it.
They're helping to fund the build-out to make sure their customers have places to charge. It's partners sharing the cost. And on top of that, their own R&D is expected to lower the gross CapEx per stall by over 25% by 2029.
Okay, so the financial mechanics are getting better, but they still have a big strategic problem. Compatibility. Half the cars on the road can't use their plugs. What's the progress on the NACS rollout?
The NACS rollout, the J3400 standard, is a huge priority, and they're moving fast. They have nearly 100 stalls with NACS connectors now.
And is it working?
The early data from those sites is very encouraging. They're seeing immediate higher usage by Tesla drivers at those retrofitted sites. They are successfully unlocking a massive new customer base.
That's crucial for future utilization. But, fast charging has a reputation for being unreliable. They can't afford to have that utilization rate drop because of broken chargers.
No, and they address reliability head on. They finished a campaign upgrading their older Signet chargers, and now they're doing a similar one on their newer Delta chargers.
Which are the ones they're installing now?
Exactly. Almost all new builds since 2024 have been Delta units. So proactively upgrading this equipment is essential to maintaining that customer experience.
Okay, let's shift to guidance. This was maybe the most complex part of the call. They gave a two-tiered structure for 2025.
They did. The baseline revenue was set between $350 and $365 million, with baseline adjusted EBITDA between -$15 and -$8 million. Pretty solid.
But then they threw in this ancillary upside. Revenue potentially going up to $405 million and adjusted EBITDA swinging all the way to a positive $23 million.
That's a huge delta, a massive range. And it raises the question, why such a wide variance and how reliable is that upside?
It all comes down to one single payment, right?
Precisely. That huge $40 million swing in revenue and the flow through to EBITDA is almost entirely due to a potential contract closeout payment.
Oh, yeah.
It relates to a dedicated stall business they were building for an autonomous vehicle partner who decided to exit the robotaxi space.
So it's a one-off.
A one-off. And they stress there's risk around how much it will be and when it will land. It could even slip into early 2026.
But it's important to clarify, this doesn't affect their core growth plans, right?
That's key. This was just a termination fee for a single contract. Management assured us it doesn't impact their long-term dedicated stall build targets at all. The pipeline for that business remains strong.
Okay, moving away from the high finance for a minute,
Right.
What about the user experience? That's so important for organic growth.
It is, and they highlighted their mobile app hitting a 4.5-star rating on the Apple App Store. They see that as a key threshold for getting more organic customers.
And they're using things like dynamic pricing to manage that experience and utilization.
Right. Version 1.0 is already network-wide, and they said it's driving double-digit utilization in the middle of the night. They specifically mentioned a bump around 3 a.m.
But they also said they're deferring version 2.0, the more advanced version of that. Why would they pump the brakes on a revenue tool?
They're prioritizing deployment over optimization. Because they're in such a heavy build-out schedule for Q4, They're racing to hit that EBITDA inflection point. They're pushing the more complex V2.0 to Q1 2026.
So it's scale first, fine-tuning later.
It tells you exactly where their operational focus is right now.
Let's put this back into the broader market context. Despite all these improving metrics, the stock is still down 37% over the last year. That's way underperforming clean energy ETFs. Why is there still such a gap?
The market is still skeptical of the whole charging space, frankly. They're weighing execution risk. When they were asked about competition, management was pretty blunt. They believe consolidation is inevitable.
Because the little guys can't compete.
They just lack the scale, the site selection expertise, and most importantly, the secure long-term financing. They think they're building a real moat with a 2 to 3 year payback period on their capital.
So we've got several huge catalysts coming up that could finally close that gap. The Q4 EBITDA inflection, the NACS rollout scaling in 2026, and just steady progress on that big dough e-loan program.
All concrete, measurable steps.
Okay, now we transition to our segment. This is not financial advice. And just a reminder, this segment is purely for discussion, driven by the data we've just reviewed, and it's based on a highly aggressive thesis.
It is. I mean, given that extreme underperformance, that minus 37% figure, while management is confirming this path to break even and has financing locked in, well, the gap between the story and the sentiment feels too wide to just ignore.
The market's waiting for proof.
It's waiting for 2 specific proof points.
So what's the outrageous but plausible trade idea designed to capture that?
So the idea we'd pitch is purchasing a highly leveraged long call spread. You may be targeting the $4.50 to $6 range with an expiration date after the Q4 2025 earnings release, which should be early 2026.
Why that structure?
It lets you make a defined aggressive bet. You're limiting your cost and capping your profit, but you're betting on the confirmation of 2 very specific events that could force the market to re-rate the stock.
And what are those 2 binary events?
First, the definitive confirmation of that positive Q4 adjusted EBITDA inflection, the moment they prove the fixed cost leverage model is real. And second, management giving strong specific guidance for the NACS retrofit scale-out in 2026.
Unlocking the other half of the market.
Exactly. And if that $40 million ancillary contract payment actually lands in Q4, it would just provide massive market-moving momentum to that confirmation story. It's a very high-stakes bet on execution.
It's an aggressive structure for an aggressive thesis.
Well,
Okay, to wrap up, our 2 key takeaways from this deep dive seem pretty clear. First, sustained strong network utilization is what's driving this Q4 profitability inflection. That operating leverage is becoming real.
palpable, yeah.
And second, the strategic moves they're making around NACS and CapEx efficiency are positioning them for the long-term scale they need to win.
Which brings us to an important final thought for you to consider as you watch for that critical Q4 report. We all know Q1 is seasonally weak. People drive less in the winter.
So how durable will that Q4 EBITDA break-even prove to be? And more importantly, will the market give them a pass if there is a slight seasonal dip in profitability in Q1 2026? That durability is the very next hurdle they'll have to clear.